Hi, in this video we're going to talk about how to make a statement of cash flows using the indirect method. So we've got three types of cash flows. You can have operating, investing, or financing. Now operating is just your day-to-day operations, cash you receive from selling goods, providing services, and cash you spend to maintain your operations, like interest on a loan, paying your employees, paying for your utilities, paying for advertising, all that. Investing is cash you use to buy property, plant, and equipment. That's an investment in your company. You're hoping to use that property, plant, and equipment to generate more revenues. It would also be money you use to buy an investment, like a short-term or long-term security. The other side of the coin, if you sell property, plant, and equipment, you sell an investment, that would be a positive investing cash flow. And lastly, you have financing. So these financing cash flows are usually very positive at the beginning of your company's life, meaning, cash from selling stock, issuing stock, cash from issuing long-term debt, like bonds. Those would be positive cash flows. But as your company matures, this category normally turns negative because you pay dividends, you pay back that debt. Those are negative financing cash flows. And here's a just general summary of what we just talked about. Okay. Now remember, when you prepare the statement, you're just trying to reconcile the beginning and the ending balance in cash on the balance sheet. So that's the first thing you do, is say, what is the change in cash? And then of that change in cash, it has to fall into three categories, right? So it has to be either, some of the change in cash can be operating, and that's step 2, or it can be investing or financing, and that's step 3. So again, we're using the indirect method. Roughly 90% of corporations use this method, so this would be the one to learn rather than the direct method. And it starts with this formula. It says net income is nothing but operating cash flows adjusted for those accruals, which I label ACC. So if you think about net income, it includes cash flows from selling stuff, from paying expenses, like we just went over, but it also includes expenses where you don't pay money. It includes revenue where customers don't pay you that year, right? So you're looking for two items which make net income not be the same as operating cash flows. And these are the items you're going to have to adjust when you're doing the operating cash flow section. One is the item that affects net income but doesn't affect cash flows at all. So you got, you provide a service to a customer and they pay on account. In other words, they're going to pay you next year. Your revenue will go up. That affects your net income, but your cash flows will not. The other item to watch for is something that affects cash flows but has no effect on net income. And so you have situations like you prepay your rent for the year. That's a negative operating cash flow, but that will not affect net income. The journal entry is prepaid rent, go up, cash go down. No net income effect there. Alright, so that's a big picture thing you got to keep in mind. I made a little example. Here you have audit and tax consultants, and we have comparative balance sheets. So you got the January 1st balance sheet, and then you have December 31st of the same year. First thing to note is that, cash goes up $16,000. Now we're going to see of that $16,000, how much is operating, and how much is investing, and how much is financing. Alright, so we're going to step 2 then. So cash went up $16,000. Step 2 says how much of that is from operating activities. And so for this, you're going to need the comparative balance sheets and also an income statement. And the reason you need the income statement, one of the major reasons is you're going to start with net income, $26,000. Okay? And now from that, remember our formula, you're going to subtract or add those accruals. You got to remove those accruals. What kind of accruals can I see on this balance sheet? Well, I see accounts receivable went up. That's an accrual. So most likely I sold something on account That increased my revenue, which then directly increased my net income. I have to take that out. Okay, so even though net income is $26,000, it's $15,000 too high if I'm trying to convert it to a cash basis, right? So I'm going to take that out. The other accrual I see is accounts payable, which goes up by $8,000. So why would accounts payable go up? Some type of operating expense. Maybe it's advertising expense, utility expense, supplies expense, whatever the case may be. Actually, not supplies expense. I caught myself there, because that only is when you use up supplies. Anyway, we don't know what kind of expense it is, but it's some type of operating expense, and there's no cash flow because your accounts payable went up. You paid on account. So what that means is, like, these expenses here on the income statement, what are the expenses here? $60,000 operating expenses. That should really be $52,000 if you're trying to be on a cash basis, right? It's $8,000 too high because you did not pay cash for that. So we got to add it back. We got to add it back. Our income number is $8,000 too low. We got to add that back to get to the cash basis. So in other words, cash basis income is $19,000, and that is your net cash provided by operating activities. All right. Now, the last step is investing and financing, and I put that all in one step because it doesn't really matter which one you do first. I do recommend doing operating first, but after that, the other two, it doesn't matter too much. And I will say this, operating is the most difficult. It's a bit of a brain twister to do the operating. Investing and financing is more straightforward, and you'll see that here. So let's do financing. I see that common stock has gone up this year by $7,000. You must have issued stock worth $7,000. What else? Okay, I see the company paid a dividend for $10,000. So I see two items. One is a positive $7,000 cash flow. You got cash. And the other is you paid cash out. So that's negative. So plus 7 but minus 10, negative 3. Cash flows from financing activities, negative 3,000. Now what you can do is back solve for the last one. And so remember, our cash went up $16,000 overall. And like I said, that has to go into one of three categories: operating, investing, or financing. We've already solved for operating and financing, and so you just plug it in. Remember, operating is 19, financing negative 3, and you see that, okay, there was no investing activities this period, no cash flows from investing. So with that in mind, the final product is going to look like this. Statement of cash flows for the year ended, and you start with net income. You have the adjustments to reconcile net income to net cash provided by operating activities, and you list them all out. Then you got OCF here. You would normally then have investing cash flows. We didn't have any. And then you have financing cash flows, and again, they're all listed out for everyone to see. And that's that. All right.